Welcome to the Invest with Carl podcast. I'm your host, Jamie Eppenberg, and a member of the Carl team. Today, we have with us the Olympus strategy team. So we have Ernest Chan and Jetha. So a little reminder on Olympus. We are Carl, digitally offering quantitative hedge fund strategies and fund of funds packaged and data-driven delivery to accredited investors. And Olympus is a tail hedger strategy that came to us from QTS Capital Management. And so Dr. Chan, Ernie, is pretty much, you've heard me describe him before as a quantitative rock star. He's written 3 books on quantitative, algorithmic, machine learning, and trading to considerable acclaim within the quant world. And he writes the popular quantitative trading blog. He's worked for IBM, Morgan Stanley, Credit Suisse, Maple Ridge Capital Management, and founded the EXP Capital Management before finally founding QTS Capital. And then joining us today is also the COO of QTS Capital Management, who is Jetha. And he is a physicist by training. That's what he thought he was going to do. And he did do that for a while, but he began building up a research program in quantitative trading during his physicist professorship. And then ultimately, he made the shift full-time into the quantitative trading world. He has set up a fully automated AI-based quantitative trading systems. And he is, as a quantitative researcher, working with top tier hedge funds and quant trading firms in North America and Europe. He has now extensive research development and obviously full platform management in quant. So welcome today, Ernie and Nahid. Nice to meet you.
Thank you.
Nice to meet you too. Thanks, Jamie.
And actually, Ernie, nice to have you back. So today we know the story is it's end of 2021 and we bring in 2022. And so we begin with Olympus and 2021. How did the year go for Olympus? Was it a good year? Being a tail reaper strategy, right? As a reminder for our guests, that means that the strategy is really going to perform when the market has a significant downturn. That's when Olympus will shine. And in other times, in flat or bull markets, when you have this type of strategy, what you would be looking for is how well did Ernie and Nahid do at protecting capital? So what did 2021 bring, gentlemen?
Yeah, well, the tail reaper Olympus strategy kind of, I guess, performed as expected in the sense that, 2021 was a great year for the market. And so we were paying our insurance premium that year. We're constantly, trying to, improve on the strategy and kind of reduce that premium cost. But the strategy itself, I'd say performed in the way it should, considering the drawdown.
Yeah. And was the drawdown what you expected or a little more than you expected? And I think when Ernie and I originally talked about the strategy, there were new controls for capital protection put in late 2019, maybe. Are those still performing as expected?
Yeah, we've kind of implemented a machine learning layer on top of Tail Reaper, and it's been performing, as expected. It's our kind of benchmark for comparison, for example, is the base level Tail Reaper or Olympus strategy without that machine learning layer in place. And so from that perspective, we saw some good protection coming from the risk management strategy. Now, again, it's something that is constantly being improved upon and constantly in R&D, and so we're always trying to improve the strategy.
And you still have confidence. I mean, what does your year look like when it's a flat or bull market? As we've, this was a good year for the market. What does the year look like as you guys manage the strategy? What was this year? Were you guys just mostly making sure, is the machine learning layer working? Is the market catching little downs? Like, what are you looking for?
Yeah. So, I mean, we're, constantly trying to minimize that drawdown. So again, like you said, the market did well in 2021. And so we're trying to, we kind of expect that tail reaper or Olympus is gonna, hopefully be flat or maybe, a bit of a drawdown. Now, 2021 was a bigger drawdown than we expected, certainly. And so this is kind of
why was that? Just because you expected a down in the market at some point?
Yeah, it's interesting. I would say, and maybe Ernie can elaborate on this, but I would say, we saw a bit of a shift in behavior, essentially after this COVID crisis. So in 2020, I guess, that first Q1 of 2020 was a really good quarter for tail reaper. But during that recovery, we were seeing a bit of shift in dynamics. So for example, what we were seeing kind of at the tail end of a day is the market, for example, might be, heading downward or crashing during part of the day. And then we would see these reversals at the end of the day, which has been kind of attributed to retail money kind of being funneled into the market. So this, this is kind of a new, shift in behavior, a new dynamic that we hadn't really seen before. All this retail money going into the market, essentially propping things
the
up.
Market up. Yeah. So you're not the only strategy that has said, or actually is about to say, some of them that the listeners haven't heard from yet, but that this has been an unusual market. Like 2021 had some oddities, and that's one of them. You would see this indication of a crash, and then all of a sudden, the end of the day, everything pops up and we just sort of go back to normal. Ernie, what are your thoughts on that?
Yeah, so no, I agree with Nahid's analysis. I also want to point out that a lot of these retail traders that got into the market because they have now suddenly a lot of time and a lot of savings because they can't spend on any entertainment during the pandemic. These traders also become much more comfortable using options as a instrument to speculate. Whereas previously a lot of retail traders, what's option? I don't understand it. Just buy stocks. But because of the popularization of the Robinhood platform, they get much more comfortable using call options in particular to express their bullish views, and it's usually bullish, their views. And and now the important thing to understand about option is that it is a highly leveraged instrument. So if they buy a call, effectively the option market maker is short a call, and the option market maker does not want to hold delta, I'm sorry. They don't want to hold delta after the close. So if a lot of retail traders buy on dip, when they see the market going down, they think this is buying opportunity, it's cheap, and they buy call option. So they might spend, they may have a small amount of money to spend on the option because they're retail traders, although aggregate, that could be quite significant, but it is also magnified by the leverage of these options, and the option market maker has to hedge their net delta exposure. And that is extremely large because of the leverage involved. And so, instead of generating, momentum like in the old days where when the market goes down, everybody is selling, all the institutional traders are selling to protect themselves from further loss. We have these retail traders that go in the opposite direction. So the option market maker are forced to respond more to the retail community than the institutional community. And one of the casualty of this dynamic, for example, is Melvin Capital, right, which lost, my goodness, 50% of their capital, backed by some of the largest, most experienced hedge funds, traders, Citadel and Point72 and all these giants of the trading industry. And lo and behold, they lost 50% of the capital. And, they are kind of overwhelmed by this bullish retail sentiment. Now, you might also take one step back and see, where does this bullish sentiment come from? Well, they are not unjustified, I might add. They are not unjustified because until recently, the Fed indicate that they will support the market and they have no interest in raising interest rate, and they have no interest in buying back stop purchasing asset in the market. Jerome Powell
they're going to keep helping, right?
Was very you might call very dovish for the longest time. So they are these retail traders are justified actually until recently for the bullish sentiment. Now I might add that sentiment has dramatically reversed in recent days, reversed, and lo and behold, tail ripper or Olympus has been performing quite well in the last while as a result. And I expect it to continue to perform well because of this drastic reversal in market sentiment. The retail traders are no longer bullish.
Yeah, and I think just managing those retail traders and those who could catch on quickly, that they are now an impact, right? They have an impact on the market. We had to react to that in 2021 for sure, because we had some funds that was unusual behavior for sure.
Yeah, like the GameStop phenomena, for example, is a good kind of thing to point at. Very much driven by retail money, taking GameStop to the roof or to the moon.
Right.
For those,
for that. And it's an interesting conversation. Like, will that last? Like, will GameStop continue to be able to hold on, or when will they begin to exit? And what then will happen? But I think it's a good example of what's out there in the market. And to keep in mind that what we're saying is GameStop isn't the only place. GameStop is like an extreme, right? But there's a lot of other investments and stocks where people, they're paying attention. If it goes down, they're going to come by. It is retail and the new Robinhood landscape. Do you guys, I think it's here to stay. I think we're just going to see more and more of this, but what the retail investors do is what I think, the pros like you guys, the professionals, are beginning to get a handle on, learn, and understand, because I don't think it's going to be the same all the time. Do you guys agree with that, or do you have a different perspective?
With respect to just retail money being in the market right now?
Yeah, I think it's here to stay, but I don't think it will always act exactly the same, right? Like you say, they always think it's a bullish market, blah, blah, but when factors change, they shift as well. So I think a lot of professional investors are getting a handle on, this is what they do in this type of environment. This is what retail investors do when the environment shifts. I think we're still learning some of that, but I think overall, this is the environment. This is the new space. Do you see it the same way or slightly differently?
Yeah, it certainly seems, post COVID that this has been the case. I kind of, bring up what Ernie was saying earlier, is that, it's there seems to be, the market dynamics are always kind of shifting. Last couple of months certainly we kind of seen a little bit of a different behavior in the market than I guess, the last, most of 2020 or most of 2021. That being said, I'm not saying retail money is exiting the market by any means, but there seems to be some a new or different underlying dynamic taking place right now.
Do you see that dynamic, Ernie?
Well, yes, I think certainly, as I said, sentiment seems to have reversed. However, the good thing about the machine learning approach as a risk management layer is that one can continue to add predictors to it. It's really the more the merrier. Whereas in a traditional quantitative strategy, typically you cannot really add too many ingredients to it before it gets overfitted, before it gets too complicated, and maybe negate the original edge of that strategy. So machine learning, on the other hand, is ideal for this situation where you say, maybe the market is now looking at retail sentiment more. Maybe the market is looking at whatever people are writing on Reddit, and stock trade or Discord or whatever social media, whatever the latest social media platform of choice, well, then no problem. There's always someone selling that data, and therefore there's always a way to incorporate any kind of new information into the machine learning input and let the machine decide if that new input does add value to from a risk management perspective. So,
right.
I said, our approach, I think, is evolved to a point that these sort of changes in the market will get incorporated or continuously, and there's no such a thing as we are getting stale or out of date. It doesn't happen, because the machine learning area is always learning new things.
Right. And I think that's the beauty of the quantitative investments, right? Is this is more data than a human can take in. And you're really saying, like, there's kind of not a limit right now. Nobody's, we're nowhere near the amount that a computer can handle at one time. And they don't appear to be washing each other out in any way. We're not canceling out the message. So that said, how are you looking towards 2022? Now I would have said, by the way, in the first half of 2021, I personally, and I don't think I said this on any podcast, but I was like, there's going to be a fall before the end of this year. I was like preparing myself for it. And this year, I'm like, oh, I don't know. There's so much bull, but it just seems like a dip is coming. And I will preface this for any of our listeners that any view of the market in the future is always a personal opinion of our guests or myself. We are not giving advice, and we are certainly not indicating what the market will or will not do. So keep that in mind. We're just chatting. But what is Olympus looking as you look towards 2022? What are you guys looking at?
Yeah, I mean, it's kind of this tricky thing. I mean, even in 2021, I was pretty surprised at how bullish the market was, or even just after the collapse, how incredible the market just roared back, which makes me, pause about saying anything about what's going to happen in 2022 with the market. I mean, I would say, for example, I'd say, the market is, looking pretty good. I know there's some concerns on the horizon, like, for example, inflation or, rising, which, is kind of something to kind of keep your eye out on. But, the market itself, it does what it does. The only thing I would say is, with tail hedge, with Olympus, when or if and when something unexpected kind of happens, it's there in your portfolio to kind of protect it. So, even if the market is, kind of rallying, your portfolio as a whole, will be doing good. And when you have kind of like a tail hedge strategy like Tail Reaper in it, then you can kind of maybe feel a little bit comfortable if in the event something totally unexpected happens with the market and you get a massive collapse.
And I'll just mention that this is Olympus and Carl. It's based on the you guys' old Tail Reaper, but our investors would invest in Olympus.
Right. Yeah. Right. Yeah. Olympus. Yeah. So that's kind of what I would say is it's a good thing to kind of put in that portfolio, but to kind of protect it.
Yeah, I mean, some people look at a Tail Reaper like Olympus in general as I just don't ever want to have a really, really bad day, right? So let's make sure something's there. Ernie, what do you think about 2022?
Yeah, so I think the major difference between an investment in this kind of alternative asset class like hedge funds and special future CTA strategies like the Olympus / Tail Reaper is that we don't need to predict where the market is going. We are not hoping for a bullish market and we are not hoping for a bearish market, because in whatever market environment, we are making money. Now, I don't mean a particular strategy necessarily make money in all environment, as you could say. As you can see, Olympus / Tail Reaper doesn't do well in a bull market. However, that's not the only strategy we trade. We trade, my goodness, probably 7 or 8 strategies right now, across different kind of asset class. Even we had someone trading forex for us, with someone trading futures, with someone trading stocks, with someone trading options, with someone trading natural gas, with someone trading pot belly futures. It's all kinds of market that we have hands on, and we might even introduce crypto trading pretty soon. So
all hedge funds are talking about that, but let's wait until it's reality.
We have a very, very successful crypto trading strategy that was developed. We just need to trade it live for a while before we roll it out to investors. But in general, we like to use the term all weather to describe our approach. And actually, all weather was not our invention. This term was invented by Ray Dalio already, so we can't claim credit for that terminology. But truly, we are looking for an all-weather portfolio where we don't need to predict whether the market's going up or down or sideways. We have a strategy that benefits from each market regime. And the beauty is that when the market regime is right, good for a strategy, it makes a lot of money. And maybe the rest of the strategy either doesn't make money, or maybe even like Olympus suffer a mind-boggling drawdown. But lo and behold, we were focusing on how big a drawdown Olympus was experiencing in 2021. But lo and behold, our fund was quite profitable. In 2021, it's amazing actually performance, and it followed another amazing year in 2020. It's truly all weather that we are able now to achieve practically no losing quarter, and every year it's double-digit return. And that is the beauty of alternative asset investment, as opposed to buy and hold, buy stock index. Sure, you got a couple of good years, but you are always trying to pray, cross your fingers that the next year is not the year that you're going to suffer a 20% drawdown. Well, our investment do not do that. We are all weather truly. We do not suffer this kind of drawdown as a whole. Although individual strategies obviously can suffer steep drawdown, but not the overall portfolio.
Right. So that's part of your view, right? Is that that portfolios, again, personal view, that portfolios should hold a type of strategy that is there for them when times are tough, when the rest of the market is tanking, as it were. You never really have a really, really bad day. And that's part of what Carl tries to do as well, is to make sure that there are a lot of options for investors, and that if they do want that type of strategy in their portfolio, Olympus is our primary tail reaper that's there for them. So you can protect yourself against a really, really bad day. And at the same time, know that you have a very, professional investors who have been doing this a very long time, working very hard every day to make sure they protect that capital when the market is flat or doing well, which is what you really want in one of these strategies. Well, gentlemen, any last words for our investors today?
Well, as everybody knows, diversification is key.
You'll be surprised, over 50% of our last words.
Yeah, the portfolio approach is the way to go.
Yeah. And I'll chime in with that as well. Carl is adding a lot of strategies. I think we've added 3 in 45 days or something along those lines. And that's a big deal. We want to make sure that you can get into the types of markets that you want and the types of quantitative strategies that you want. All the strategies are not the same. We have some that are coming on that are quite unique, and they take into account global markets and different investments. And this is the alternative investment world, where there are more options now than ever than just that stock market. So take a look and see what you like. Thank you so much, Ernie. Thank you so much, Naheed. And thank you to our listeners. We will see you next time.
Thanks, Jamie.
Thanks.
Bye-bye.
Bye-bye.
Bye.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.